There we are. So this is our gang. I'm going to turn this over to Ralph. Are you there?
Here.
And he's going to moderate, and I will sort of put up their little headshots every second or two as we go.
Okay.
But when you're ready, take it away.
Thank you, Todd. I appreciate that Real Estate Journal put this together. We are here, and I'm glad that you put this before lunch. Usually you put capital markets as a panel right after lunch, and it's a challenge to be a moderator to try to keep everybody awake. But
don't you think everybody's just going to eat their lunch whenever they want to now online? I think I've already started on mine.
Yeah, well, that's kind of, that's one of the nice things about virtual conferences. You can work and listen at the same time. The first thing we're going to do is we're just going to introduce our panel. I'm Ralph Cram. I'm the president of Envoy Net Lease Partners. We're a build-to-suit capital partner. We have a $200 million construction loan fund, as well as a joint venture fund, as well as other pockets of equities to fund new developments, redevelopments of net lease, single tenant deals. Why don't we go to Caity? Why don't you give yourself an introduction?
Sure. Good morning, everyone. I'm Caity McLaughlin. I'm a director in Prudential Private Capital. I'm on a team that focuses exclusively on credit tenant lease investing. So we're investing Prudential's money, making debt investments in CTLs. And so any CTL essentially is covered by my team. So we have a good breadth in terms of geography and property type.
Ben, would you like to give an introduction?
Sure. Ben Hidalgo, our company is Net Lease Development. We invest in triple net properties across the country through development and acquisitions with a primary focus on restaurants and retail.
Nafi?
Thanks, Ralph. So my name is Nafiz Linkon. I'm a vice president of investments, and I work at iSTAR, which is a publicly listed diversified REIT with $6 billion in assets, of which about $2 billion plus or minus is in net lease. And within net lease practice, we're very opportunistic, and we like to partner with companies that have long-term moat and do engage in corporate sale leasebacks. So I'll turn it over.
Mark, why don't you give an introduction, and then Mark is going to give an overview of the capital markets in general, and then specifically to net lease properties in specific. Go ahead, Mark. Mark, you're on mute.
There we go. How's that?
That's better.
Yeah, good to see you again. Good to see everybody. My name is Mark West. I co-run the Net Lease and Corporate Finance Group at JLL Nationwide. My partner is Kohler Yoakum, and we have actually three very separate verticals. One is a net lease practice group, which deals in smaller retail single tenant transactions. And then we have our corporate finance group that is really more focused on larger portfolios and sale leasebacks. And then we also have our structured finance group, or CTL group, that we do some CTL work with some of the corporate clients and developers that are our clients as well. Been with the company for, well, actually HFF legacy, 20 years. So I've been doing strictly net lease for a little over 10. A big part of what we do, as Ralph mentioned, is debt placement. We're the largest debt intermediary in the country. And we are very active in that space across all product types, but we're very active in it as it relates to the net lease business as well. And that's everything from banks to life insurance companies to the CMBS market, debt funds, all across the board, whether it's short-term floating all the way to something that's longer term, like what Caity would do in the CTL structure, which is more 20, 25-year non-recourse fixed rate financing. I would say that, you know, coming into Thanksgiving, the debt markets are in a way better place than they were March the 15th. There is no shortage of capital, and net lease is one of the asset types that is very, very desirable by the lenders because of the long-term durable cash flow of the assets. So really any product type, if you've got some lease duration, the capital markets, debt markets have opened up quite nicely. What has not completely opened back up would be the debt markets for something like hospitality or a mall or things like that. But as far as net lease product, there's certainly plenty of both floating and fixed rate at historically low levels. And I think that's having an impact, and be curious to hear what people think about the cap rates, because I think it is having an impact on cap rates because the cost of capital is so cheap. And Ralph, I'll leave it at that unless somebody has a question.
You know, what's the biggest challenge for net lease borrowers right now? I mean, I think like most of commercial real estate right now, there's kind of a tale of two cities. If you have investment grade tenant, you got 7-Eleven, you got various other tenants or industrial long-term leases, you can you'll get multiple bids. But if you have a net lease gym or daycare center or anything that has any service component to it, how are those deals getting done, if they are getting done at all?
Well, a standalone gym would be very difficult to get done without, when you get into those types of financings, your kind of lender of last resort there is going to be, it's going to be bank, and it's probably going to have some recourse attached to it. Okay. So that's the only way that you really can get those things done today. Most of the financings that we do are non-recourse, so we don't play in that arena quite as much. If there's recourse attached to it, it's probably because there's some construction going on. So the challenge assets, until they're up and running and are occupied, they're very, very difficult to finance.
And so what is the insurance company market, or mention just a little bit about the CMBS market for net leases right now? Is that open? Is it selective? I mean, it was a mess 4 or 5 months ago, but from what I hear, it's starting to open up, and for definitely for industrial and multifamily. But how is it for net lease properties?
It's very active. It's very active. We're actively financing sale leaseback transactions that we're selling currently in the CMBS market for institutional clients who, some of them have been on your panels today. So the CMBS market is open, and that, you can borrow money for 10 years fixed, in the threes. So that makes it very, very attractive. And it doesn't have to be investment grade. What it has to be is it has to be a very solid business that is, essential business. And there's plenty of those out there. We recently did a sale leaseback on an emissions inspection business that had 52 locations. Wow. That's, that you can finance that. And that's not the sexiest real estate, but those are all state contracts. There's 2 or 3 other nice large sell leaseback transactions that are getting done. So the CMBS market is very competitive. And I would say most all of those lenders are back in the market. There's some that left the market or probably won't come back, but there's a healthy number of those lenders. And you get down to a single asset, more of a retail play like a 7-Eleven or something like that. There's plenty of liquidity for those. It's just normally it's not going to be in the CMBS market. The life insurance company market is absolutely back in business. And you know, they do like long-term durable cash flow. So they like net lease assets. What they don't like is something that is not essential. But if it is essential and it's a strong business, then they absolutely will lend in that market.
Good. For our audience, what is the advance rates looking like for the, for the tip of, let's do the bigger guys, and then for the $2 to $15 million range type of transactions, which I like to call as retail, but it's really the private market.
Private market, 7-Eleven, you're probably getting a 75% advance rate.
Okay.
That's 5 years or 10 years with maybe some interest only on the front end, and then it shifts to amortization.
Okay.
On the bigger deals, you're generally around 65% of cost on a transaction, and the debt yield is somewhere between 8.5 and 9, and you can get 5 years of interest only on a non-recourse basis. And then when you shift to investment grade, Caity can talk about that. But if you got long-term investment grade lease and you want to do a CTL financing, then you can, depending on the structure and the pricing, you can get north of 75% easily, and sometimes closer to 100.
Okay. We'll get back to the cap rates. I think that's a good question of, is the capital markets driving cap rates down? We'll get back to that, but I'd like to move on and talk about the CTL market. Caity, give an update on the CTL market. What's Prudential doing today? We briefly mentioned, but I think the residual back-end market is coming back, so you can actually get a CTL transaction done with a 15-year lease now, which was it's always been problematic in the last couple of years. So that's actually good news for that execution. And then we'll talk about build-to-suits later when we talk about build-to-suit financing, but that kind of is between investment grade developer financing and non-investment grade. We can have a conversation about that. So go ahead, Caity.
Sure. So I would just echo what Mark said in terms of all the activity that we're seeing in the market. A lot of it is driven by where rates are. CTLs, the way that we price them is based on the underlying credit. So it's based on sort of what's going on in the corporate bond market. And there's been kind of record issuance on the corporate bond side. And I did take a look at just where the 10-year treasury was last year at this time. It was at 181 and it's now at 85. So that's about 100 basis point, decline in terms of the underlying treasury rates. And so just given how low overall rates are, it's a great time to take advantage of, from a borrower's perspective, a great time to take advantage of, all in low fixed rate financing, especially given that it is very long-term. As you mentioned, kind of 15-year leases usually is the starting point of what we see, where you really get the benefit of CTL execution. Sort of the longer the lease, the better, because the way that CTL financing is sized is it's really just, a present value of the rent payments that are paid under that lease. So to the extent that you have a long-term non-cancelable lease with a high high quality credit tenant, especially with, sort of essential, essentiality of the asset to that tenant, like Mark mentioned, that's sort of a sweet spot where CTL works really well. So we have seen a lot of activity this year, on our team, and just, I would say, the market more broadly. And so that's driven by, in part, like you said, build to suit, construction activity across, certainly industrial, but then other property types, healthcare, municipal type property types, and then also use of proceeds to facilitate acquisitions of properties, and then also sale leasebacks. So we've seen a lot of activity kind of across the board.
And what's the mix? Let's go back to November 2019 to today.
Yeah.
What's the difference of the mix? I mean, we have a 100 basis point drop, so you have a lot bigger market than you did a year ago, and there's a lot less longer term capital players. So you can talk to it, and also Mark, if you want to chime in a little bit about that as well. Just kind of how does that box fit now compared to a year ago, which was primarily, if I remember correctly, pretty much institutional products is what was most competitive at that time.
Yeah, I mean, I would say in terms of the mix of the types of opportunities that we're seeing, it just seems like there's a lot of activity across the board. I know kind of in sort of the March timeframe, sort of when lockdowns first started, there was some dislocation in the market, I think across the board, but that seems to have, corrected itself in terms of other, types of capital outside of CTL, but we're continuing to see a lot. I mean, I would say on the pricing side, rates are really low. I would say there's probably, investors are thinking about things on an all-in yield perspective. So that's probably something that's a bit different in the market from last year, where you could kind of just think of, some sort of spread on top of, where a public benchmark would be. Whereas now investors, obviously given how long, the long duration of CTL investments, investors do want some level of yield. So that's certainly been a part of the conversation now, kind of throughout the year. So that's a little bit different from where we were last year, but certainly just continues to be a lot of activity. On the construction side, we've seen that for the past several years. But I will say one thing that's different this year is there seems to be more opportunities where tenants are looking to monetize assets that they may have and generate liquidity through like a sale leaseback, which helps, raise, capital and provide a liquidity source in more of an uncertain market. Another thing I would say that we saw, and there, I feel like always at the end of the year, there's always, a push to get things done. But certainly before the election, we saw, a lot of momentum to try to get certainty about transactions because there's a lot of unknowns as far as, not only rates, but just in general, the market kind of going forward.
Okay. Mark, do you have anything to add?
Well, the only, I think a couple of things. I agree with what Caity had to say there. I think what you've seen in the last year is you've seen a number, almost every company, public or private, rated or unrated, take a look at their real estate and try to figure out, should they be monetizing that real estate and why are they holding it on their books unlevered, because everybody is trying to shore up their balance sheet. So you had, and still do have, companies reviewing that on a weekly basis. So we've had numerous calls with number of different companies trying to figure out whether it makes sense to do a sale leaseback or finance that position. And I do. The only other thing I would add to that is recently, in the last couple of weeks, we're starting to hear, which Caity alluded to, is the all-in coupon game coming back, because life insurance companies are really like real estate, they like mortgages, and they have, for the past 20 years, been increasing their allocations to real estate and to mortgages because they can get some yield in an environment like this where the 10 years at 80 basis points. They'd much rather go make a mortgage at 380 instead of buying a bond at 80. It's just hard for them to run their business at negative interest rates or at 80 basis point treasury. So you see what we're seeing life insurance companies shift, and we've heard over the last couple of weeks that they're shifting to take on a little bit more risk to get a little bit more reward because they just cannot afford to chase the spreads down and the rates down anymore. So they're having to go to do different product types. So starting to look at some power centers and retail and things like that. So that's a definite shift in the last 30 days.
Well, I think the guy who used to run AIG's CTL used to say it cost him 3% just to keep the lights on for a mortgage. So that's kind of it. Nafiz, you do a lot of the non-investment grade tenants. You're working with iSTAR, trying to create opportunities in that area, financing wise, as well as you're probably having a lot of the same kind of conversations Mark is having about, and iSTAR pretty much, and you correct me if I'm wrong, that you focus on B credits. So you're not going to, you might create a CTL transaction, and that you can talk about that. You mentioned that on the phone yesterday, but just tell us how your business in the B and B credit and the corporate side is going.
Sure. Yeah, I think, with respect to iSTAR, we are pretty flexible and we do look across the credit spectrum. So we've looked at credits in the BBB, A range, and, I think given our cost of capital, we find ourselves more competitive in the B sort of, that's like our sweet point. It's an interesting environment, I think, from when you go to banks who finance a lot of these assets. Sometimes these banks are financing the company's other securities and are having great success doing so. For example, issuances of bonds, corporate equities. But when you go to the real estate desk, they come to either a yield floor or some sort of regulatory concern regarding the credit rating given the current environment and the caution around the current environment. So you're not seeing the same amount of capital market or liquidity for those sort of credit profiled transaction. But I do believe that that will come back once we come out of COVID. And I continue to believe that we're going to be in a low interest rate environment for some time. And you may actually see some compression on the spreads as things start to normalize and capital markets start to open up for all sorts of.
We're running a little bit short on time because I would like to move on to build-to-suits. Talk to Ben. He does quite a lot of the development in my product type, which is the $2 to $15 million range. I'll do that. But why don't you just start, Ben, on financing, cap rates? How is your market going this year? And another thing that I want you to, at the end, is talk about is tenant demand, as well as costs and supply chain issues. Have you seen any of those in the development area because of COVID, as well as we're starting to see some certain product types or smaller markets where construction costs are actually going down right now. So go ahead.
Yeah. So I'll start from the front end of the development cycle. So tenant demand, what we've seen is on the tenant demand, a huge reduction in tenants that have availability, capacity, willingness to grow. So I think the quality tenants in the retail and restaurant space that are able to expand right now is maybe it's less than 10 tenants. Like, I mean, you've got your top tier QSRs, you've got your 7-Elevens, you've got, a couple other convenience stores. And then you're maybe maybe a couple of the auto guys are still doing deals as well. And that's it, where it used to be that was maybe 20, 30 tenants, a year or two ago. It's really shrunk down on tenants that are able to grow. And that's a function of a couple of things. I think right now it has to do with their business and how they're doing. But I think even prior to COVID, it was a function of cost and affordability. We saw a huge run up over the last 4 years in construction costs and land pricing that made it, almost untenable for some tenants to get a new product built in their price range of rent. Or even if they're doing self-development, they couldn't afford the land or the construction costs that would fit into their business model. So that's what we've seen over the last several years, is a run up in cost and a shrinking pool of tenants that are expanding pretty drastically. Moving next, I guess, towards cost. Again, a huge run up in cost over the last 4 years. We've seen that plateau this year, but it was also combined with a huge supply, or a supply constraint on materials and labor. I think it even reached the Wall Street Journal on issues with lumber supply. You had, mills and other production lines shut down for 3 months. So that, that equates 75% of the available product as you have in a normal year. And then you actually had a run up in demand for a lot of building materials, specifically lumber, as people were, trapped at home. They're trying to do every home improvement project they could. So, the Home Depots are selling out of all lumber supplies, and every restaurant is trying to figure out how to add a patio that didn't have a patio. So there's a run on lumber there as well. So we saw an issue with getting supplies on a couple projects, and then the labor was the other challenge. I know we are in a much higher unemployment rate where we've been this time last year, but our clients that are running fast food restaurants or convenience stores can't hire at $15 an hour, and contractors can't hire at $20, $25 an hour because they can't get people willing to do the work. So we run into issues with contractors having challenges on even getting enough people to accept more work. That said, we saw a flattening of costs this year, potentially up to 5% reduction in costs from where we were pricing stuff, call it end of last year in January, to where we were over the summer. It took a lot of work to get there. We went back and tried to tell a lot of contractors, don't you know we're in the middle of a pandemic? Don't you want the work? And we're successful on several of those, getting the prices down from their initial bids, kind of working with them to go back to subcontractors, probably max of 5% reduction. And then moving next to the financing side, again, if your pool of tenants is shrinking and they're all high quality, the financing is there. I'd say from debt and equity, there's more liquidity in the system, I think, all the way around than we even need. So you got lots of options to go to. I think some of the local banks were very cautious for a few months, but I think that most of them are all back to wanting to lend. They're being pickier, but I think also there's kind of been a process where, again, the tenants that are expanding are higher quality, so everyone's kind of comfortable with that. From a financing for us, our leverage ranges from 70 to 80% bank debt. You'll require the required guarantees on construction, and rates have come in, but again, if you're not going to some of the big banks, the smaller banks really can't offer you the same pass through on interest rate that some of the larger banks can, in my opinion. And then to cap rates, I think
Ben, advance rates are about the same, because earlier this year, a lot of banks were cutting advance rates by 5 or 10% on construction loans, but are they back up to that 75 to 80% loan to cost range now?
Yeah, we never got quoted, I guess, lower advance rates. But I think that's because we go to a handful of banks that we've, done business with for years, and they've got a, allocated amount of capital for us, and we just, continue to go back to them and pay off timely and keep a lot of deposits at their bank, and they're, happy with us. So we didn't see that, but I definitely can see how that would have, been an issue across the board.
I think early on, Ralph, when you saw things like that, most all banks and life insurance companies as well, everybody turned inward and were looking at assets on their books and working through those assets to make sure that they had control of any issues on their books. And that caused them to maybe take their eye off the ball as it related to new lending. And it's taken a long time for some of the, even like Bank of America, until recently, they just were not doing really anything new without you being an existing client. And really everything was inward focused.
And that's what we're seeing. If you have existing relationships right now with banks, they're pretty much open for business. But if you're shopping for new business bank relationships, not very many people people are coming to us as an alternative quote versus in the past where there'd be multiple new bank relationships or new banks bidding on business. We're not seeing a lot of multiple bids. If you're a newer developer or if it's a one-off project, it's much harder to find construction financing than it was a year ago. Todd, I think we got about 3 minutes left. I just want to mention a few things here in my summary, listening to the panels and everything. But I'm old enough to remember Sam Zell in the early 90s. He used to say, stay alive to 95. We focus on the build-to-suit market. My theme is jump to 22. Next year, we have to get through this COVID thing. That's probably a 6-month window here. Once the blue sky starts lifting, I think the sale leaseback market is strong now. I think it's going to continue to be strong next year as companies are rebuilding their balance sheet. And then once they rebuild their balance sheet, if they're public especially, they're going to be forced to grow. I just listened into a conference on restaurants. We see the QSR business picking up significantly next year. A lot of the large franchisees bank their PPP money. They have strong cash flows. Their franchisors are going to be starting to push them next year to expand and do those either remodels or so forth. We also believe, there's probably 2,000 to 3,000 empty single tenant retail buildings coming up. We're starting to see the first ones. We just are seeing a package of retrofit Pier 1 deals. Some of them are tear downs and some are retrofits, but we see that to be a very active market. And then on the industrial side, a lot of these, what I call the last mile buildings, these are the smaller buildings. These are the 120,000 square foot or less. They're on the sidelines. People have a lot of projects that are just there and they put them down. But I think next summer they'll pick them up again. And so, if you can stay alive to 22 or jump to 22, I think 22 is going to be a great year for everybody here. There's a lot of capital in the marketplace. It's going to that needs to be placed. The strong tenants, the strong QSRs are going to come out of this. Land prices are going to stabilize. There are going to be some good sites. Ben will be able to buy good sites. His tenants will be able to locate good sites. We see a continual closing of bank branches, which are going to open. A lot of bank branches are good locations. We see that opening up because last year, a lot of complaints, like Ben said, was you just couldn't, where you want to be, the land was too expensive. You're talking about $1.5 million for an acre or $2 million for an acre. I don't think land prices are going to drop that much, but I think there'll be a lot more availability of those type of sites out there. So that's kind of, if you can get through 21, I think 22 and 23 are going to be great years for everybody on this panel, as well as our development clients. And over to you, Todd. I think we're at 11:20. That was turnover time, correct? Or not.
Ralph, I see the next panel starts at 11:30. So we
Okay.
might have
We have 5
another
minutes.
9 minutes to, yeah, or 5 minutes to take questions.
Okay. What else? Then let's talk about financing sale leasebacks. Mark, what are your options if you have a sale leaseback transaction right now? What are you recommending your clients execution? Nafiz, you can jump in on this question. What are the various sources available right now, and what's probably the best execution?
That's pretty hard to broad brush. Where we're seeing the most activity is private companies. A lot of them are PE sponsored businesses that are really good core businesses, and really sticky real estate, not necessarily we're doing, I'll give you an example. We're doing one right now that's a pest control business in California. It's a very nice business, but not the sexiest real estate. Again, it's locations where, the trucks park and leave in the morning and come back. That was heavily contested. Probably had a dozen people that bid on that. That's going to get financed in the CMBS market, and probably have 10 bids on that debt. So what you're seeing is the typical net lease investor who are up and down all these panels today, whether they be a fund or a REIT or whatever. If they can go buy assets at on a private business and not the sexiest real estate at a 6.5% cap rate on a 20-year lease with 2% bumps, and they can put 65% leverage on there at 3.5%, 10 years interest only, the cash on cash return that they generate is really, really attractive. And there's in a low yielding environment that we're in right now, there are all kinds of investors that would love to invest in that type of asset. So that's a pretty good summary of what we've seen, starting right in the middle of COVID. If it was a really good business, those types of transactions getting done.
Mark, is no one concerned about residual value in that case because they just want to rip their cash flow? They don't look at it as the cash flow they get is really a large portion of it should be return of capital, not return on capital.
Yeah, I mean, I think both of them. It depends on the investor too, right? So you have foreign investors that look at, especially Asian, Middle Eastern capital that looks at the model is really more of a 5-year deal, 5-year interest only, 60 to 65% leverage, high single digit to double digit cash on cash return, go in and out the same cap rate. After 5 years, you've had 5 bumps. So even if you sell at the same price, they're very happy with the cash on cash return. So it's a completely different model than a standard real estate model where you're looking at an IRR and things like that, because the lease term is so long, and it's a durable business. Like pest control. Don't think pest control is going away. Don't think vehicle emissions is going away.
Are those getting done at 15-year leases or 20-year leases?
Both.
Okay.
Both, but they generally all have annual bumps too. So, I mean, you name it. I mean, that iSTAR, Angelo Gordon, LCN, Lexington, Verit. I mean, they're all up and down AR Global are up and down your panels all day long today. So
Okay.
iStar's public, they got to pay a dividend. For REITs public, they got to pay a dividend, but you can pay a good dividend when the metrics look like that.
And you bring up a good topic, foreign capital. Is it coming in? Is it stable? I mean, in the spring, everyone's talking, there's a lot of foreign capital, but it's not coming in because they couldn't get on a plane and look at the assets. I think there's a rule in Germany that you have to actually look at the assets and so forth.
Yeah. So
Nafiz, yeah, Mark and Nafiz, you can.
It's certainly slowed down because there are countries that you have to look at the assets, but there are some overseas investors that have offices in the States so they can get to the sites. Early on, that was a real challenge. But you know, it's like a lot of things during this COVID. You know, we started out with how you're going to get an appraisal and third-party reports and all those kind of things. You know, people figure it out because people want to get back to work. People want to get their money to work. They want to make investments, and you know, once they kind of got settled in, as long as you know we get some kind of vaccine or something here before too long, it should. I think your 6-month horizon is probably pretty accurate. There's a bit of a spike. I mean, I'm from Dallas, so there's a bit of a spike going on there. But, you know, we just hope that it doesn't completely shut down again. That's tough on everybody.
Yeah, I think the only thing I'd mention to that, Ralph, and I think, you know, we kind of discussed this, is if you look at the data, you know, international capital flow into the US relative to last year, or even over the last 5 years, it's been like low, if not non-existent from the usual players. And a lot of that has to do with the fact that they can't conduct their regular due diligence, as you mentioned. So, you know, we have seen that. You know, with respect to your question, Ben, on the residual, when we're executing long-term leases at iSTAR, typically, so the way we think about it is we look at the return on the asset, and hopefully the lease stream, if you buy into and believe in the credit, helps you amortize to a residual value that you can stomach at the end, which we consider to be dark value, or whatever you want to call it, vacant value. So I think right now it's an attractive and interesting period in time. I think investment grade credits get great financing, and there's some opportunities within the high yield market, because a lot of that capital isn't back yet, given there's just other external pressures on financing those sort of assets and credits. So I think there's interesting opportunities on both ends, and if you continue to believe interest rates hold where they are for at least 2 to 3 years, I think there's going to be great outcomes once this COVID is over.
It's been a great panel. I think there's a lot of information that borrowers can use, and I appreciate all your different opinions. And Todd, I think we're ready to turn it over to you.